Okay, Assalamualaikum. My name is Faris Adam bin Muhammad Salahuddin. My matrix number is 23DLS19F2028. I from group 5, and today I would like to explain about the provision for the full debts. Okay, the provision for the full debts is the estimate amount of bad debt that will arise from account receivable that have been issued but not yet collected. It is identical to the allowance for the full accounts. The provision is used accrual basic accounting, so that an expensive is for probable bad debts as soon as invoice issues to customers, rather than waiting several months to find out exactly which invoice turned out to be uncollectible. Thus, the net impact of the provision for that full debts is to the resolution for bad debts into early reporting periods. A business typically estimates the amount of bad debt based on historical experience and charge this amount to expenses with a debit to the bad debt expenses account, and a credit to the provision for the full debts accounts. Okay, the organization should make this entry in the same period when it bill a customer, so that revenues are matching with all applicable expenses. Okay, the provision of that full debts is an account receivable contract account, so it should always have a credit balance, and it's listed in the balance sheet directly below the account receivable line item. The two line item can be combined for reporting purpose to arrive at a net receivable figure. Later, when you identify a specific customer invoice that is not going to be paid, eliminate it against the provision for that full debts. This can be done with a journal entry that debits the provision for that full debts and credits the accounts receivable account. This merely nets out to accounts within the balance sheet and has no impact to the income statement. If you're using accounting software, credit a credit memo in a amount of the unpaid invoice, which creates the same journal entry for you. It is high unlikely that the provision for the full debts will always exactly match the amount of invoice that are actually unpaid, since it is only an estimate. Thus, you will need to adjust the balance in this account over time to bring it into closer alignment with the ongoing best estimate of bad debt. This can involve an additional charge to the bad debts expenses account if the provision appears to initially to be low, or the reduction in the expenses if the provision appears to be too high. Okay, that's all for today. Thank you very much.
Okay, Assalamualaikum and very good afternoon to Puan. So this video I would like to explain about provision on provision debt, doubtful debt, and what it effect on Soci and Sophie. First of all, I would like to introduce myself. My name is Muhammad Ifan Zahir. My mentor number is 23DLS19F2038. So I'm from DLS 1B. So this video I would like as I said, this video I would like to explain about provision for doubtful debt and effect. So first of all, I would like to add more about provision for doubtful debt. As my friend Farid has been explain about provision, but I just like to add more. So the provision for doubtful debt is an estimated amount of bad debt that are likely to arise from the account receivable. that have been given but not yet collected from the debtors. It is similar to the allowance for doubtful account. So that there is a provision for doubtful debt. Next is what effect on SOCI and SOFP. Bad debt direct off method. The method involves a direct write-off to the receivable account. Under the direct write-off method, bad debt expense serves as a direct loss from uncollectibles, which ultimately goes against revenues, lowering your net income. For example, in one accounting period, a company can experience large increases in their receivable account. Then, in the next accounting period, a lot of their customers could default on their payment, thus making the company experience a decline in its net income. Therefore, the direct write-off method can only be appropriate for small immaterial amount. So, next is bad debts allowance method. When it comes to large material amounts, the allowance method is preferred compared to the direct off method. However, many companies still use the direct off method for small amount. The reason for the preference is because the method involves a contra asset account that goes against accounts receivable. A contra asset account is basically an account with an opposite balance to account receivable and is recorded on the balance sheet. The reason why this contra account is important is that it no effect on the income statement accounts. It means under this method, bad debt expenses does not necessarily serve as a direct loss that goes against revenue. The three primary components of the allowance method are as follows. Estimate uncollectible receivable. Record the journal entry by debiting bad debt expense and crediting allowance for doubtful accounts. When you decide to write off an account, debit allowance for doubtful accounts and credit the corresponding receivable account. So sometimes people or businesses pay back the amount by a later date, which means that you need to reverse the write-off you made and record the collection of the receivable. It will involve the following entry. So I would like to add more what is bad debt. So bad debt is amount due from a customer are not recovered. They are known as bad debt. Irrecoverable amount is a loss. If a person files a petition in bankruptcy, his creditors will generally write the amount due from him off as a bad debt. So that's all from me. Thank you for watching this video. I hope you enjoy, and thank you very much.